going to have one of the members of our board of advisors, Paul Szcepaniak. He's with J.P. Morgan, come up and moderate this fireside chat with Jeff Ransdell of Fuel Venture Capital. And it's going to be a chat about, Miami's VC tech ecosystem. Speaking of which, we thought it was just going to be these two, but our ecosystem's so strong, sometimes people pop in from New York. So we have David Weisburd, who's also the co-host of the 10X Capital podcast, who's down from New York. He's going to join the conversation.
So Jeff, David, thank you again for making the time to be with us today. I think where we're going to focus our conversation, we're going to try to make it as natural as possible. We obviously want to focus on your path into venture, why Miami is such a central part of that decision for you, both from a personal and from an investment perspective. And I think if we focus on a theme that I think has been repeated a few times today, which is disruption, how does that theme show itself through the various technologies that you may be interested or investing in at the moment and into the future? So, Jeff, I don't know if you want to kick things off in terms of kind of your path towards venture and why Miami has become, your HQ. Great.
So it's nice to be here. Good to see everybody. What a great event. So thank you for putting it on. So how did I get into venture? I was an entrepreneur early in my let's just call it life cycle. I started 4 businesses when I was a young man, and I ended up selling those companies off. And I really didn't know what I was going to do with the rest of my life. I figured I'd just keep building companies. And I was introduced to a pretty legendary guy by name of Dave Kamansky, who was the CEO of Merrill Lynch, which at the time I had no idea who the hell he was or what Merrill Lynch was. But I was invited to a lunch, and by the end of that lunch, I had taken a job working for him, and I spent 21 years on Wall Street doing a number of different things. And the attorney who did my employment agreement, who at the time I didn't even know really that she had done it, but it was a brilliant move. Because it's a FINRA-related, very regulatory industry, I was given the ability to invest. It was called an outside interest approval. And so I was able to continue to invest in companies and private organizations. One of the companies I had built, I sold to a gentleman who started one of the very first music streaming platforms, which ultimately ended up being the Apple iTunes that you have on your phone today. So how I really got into venture is I was an investor myself. You can call it an angel investor, I'm not really sure. Some of the checks were much larger than angel checks, but it worked out very, very well for me. In 2014, I was actually telling the story. 2014, I sat down with my boss, who was then a guy by the name of Brian Moynihan, who is the CEO of Bank of America. And I just had this conversation with him about my opinion that we at Merrill Lynch had a responsibility to our investors. Now again, remember, this is 2014. So private clients, right? Two-legged individuals like all of us, not institutions, endowments and insurance companies who have been taking advantage of the private markets for over 25 years. And I felt that we had a responsibility to give private clients, global families, access to the creative economy. And that conversation really didn't seem like it was going to go anywhere. And so I started to put my plan in place, and I took a package in 2016 to start Fuel Venture Capital in Miami in 2017. So why Miami? I think it's an interesting story because in 2017, everybody thought, anyone who knew me from New York and knew who, in my prior life, thought that Ransdell had completely lost his mind. If you're gonna start venture capital firm, you sure as hell don't do it in Miami, Florida. You do it out in San Francisco, Silicon Valley, et cetera. But one of my responsibilities at Merrill is I ran Latin America and the Caribbean and all of Florida. And so I knew the market very, very well, and I just anticipated that, Latin America, one of the most fascinating things about Latin America is if You either have money or you don't. There's really very little in between. And if you come from a family that's well off and has the ability to send you to school, you come to the United States and you get educated. And then those educated kids want to go back home, and they build, companies, they build tech companies. There's a lot of really interesting things going on in Latin America, and I just thought that it would become an important part of the ecosystem moving forward. 2020 rolled around, made me look like I was really smart when I had nothing really to do with that. But that's really, in a quick way, well, it may not seem like a quick way, but in a quick way, how I got here.
Well, we appreciate it, and I think you definitely set a blueprint as one of the early movers to Miami to create this ecosystem that we're living in today. And David, thank you again for getting off a plane from New York and joining us today. Hopefully it becomes permanent, similar to what Jeff has experienced in the last few years. Talk to us about not only your path towards venture, but your path also in expanding, your podcast, how you communicate about venture, how you expand the audience that you're speaking to, how that is incorporated in potentially a sourcing model. I'd love for you to explain to the audience kind of your unique approach to not only venture investments, but also venture sourcing.
Yeah, thank you, Paul, and thank you for the invite. As Paul mentioned, I'm fluent from New York, but we also have a place here, literally looking at it in Miami, so we're here quite often as this week. My path to venture there's really two paths in venture. One is start a company and become a venture capitalist. Another one is work at a venture capitalist and climb up in the corporate ladder. I did the former. I started my first company straight out of undergrad. Ended up raising $18 million for that company, raised from Founders Fund from Peter Thiel and a bunch of other prolific investors. Sold that and then started another company. And then after that company, sold that as well, was burnt out. And as a startup CEO and startup founder, you have two choices. One is start another company, and one is start a venture fund. There's really no other career choice. So I was too burnt out from being a startup entrepreneur, so I decided to start a venture fund. And that's my path to venture. In terms of my, I guess my second or third career in podcasting, it's been an interesting experience. In your career, it's as important to be lucky than good, and I hit a couple tailwinds. One was, and one very, I think, smart strategic decision in retrospect, which I started the first podcast to really focus on limited partners. Limited partners are those who invest into venture funds. I have one of my guests here, Fernando from Variantes. I forget which episode you were, but somewhere in the 60s or 70s. For lack of a better analogy, it's similar to a frat party at a university where you want to first want to invite the girls. If the girls are there, then the guys will show up. So we started with limited partners. We became the #1 podcast for limited partners. And then after that, I could really have any top VC on the show. I've had people like Jason Calacanis and David Freiberg from All In. I've had Mike Maples, and then famous celebrities as well, like Jake Paul, Alex Hormozy, Ryan Serhant, Sasha Peters, all these. Just like any business, you focus on one very specific value add to the community. You build out that value add, and then in some business models, you have the optionality to kind of go into other verticals.
That's extremely interesting, and I think it'd be a great pivot now to focus back in on the portcos themselves and understanding what the makeup of those portfolio companies is now in your respective firms and strategies, and if there is a path towards incubating more companies either in South Florida or more locally here in Miami, and what are the pros and cons of that approach?
I think there's a couple things, and as a venture capitalist, I think everybody pretends to be contrarian, but few people are actually contrarian thinkers. So in order to build big, enduring businesses, you have to be early to a trend before other people identify it. For any market, whether it's Miami or any other market, you have to think about what is your right to win in the marketplace. So if you think of Miami as a competitor to New York City, to San Francisco, to LA, Miami has a couple advantages. One is, obviously, many people consider it the capital of Latin America. I think playing to that strength, any business that focuses on Latin America should have a headquarters here and has a huge competitive advantage. The second one is lifestyle based. Both me and Jeff are investors in a company called Betr, and Betr is able to systematically recruit top people from other markets, including New York, that want to either move for weather or for lifestyle. So really focusing on the strengths versus trying to be everything to everyone is where I've seen Miami companies do really well.
So I think for us it's a bit different. So again, if I go back to how I introduced myself, I'm still an investor in 2 or 3 very large venture capital firms in Silicon Valley. And when I started to do the formulation for what is today Fuel Venture Capital, I went through a little exercise which I refer to as an overlap analysis. So Fund A, Fund B, Fund C. And what I realized is 28% of the companies that I was overall invested in, I was in all 3 funds. So, that's, diversification 101, that's not great, right? And so what I thought was, how am I going to differentiate myself in the venture capital world, right? There's a lot of incredible managers that are out there, and how am I going to differentiate myself? So for me, one of the big reasons to start off in Miami is I wanted to, not just say that we were different, but look like we were different, and that was a good way for me to do it in a true international city like Miami. And what I believe is that borders and boundaries have really been democratized because of technology, and that a lot of technologists, a lot of founders that are out there, they don't necessarily have to journey and over to Silicon Valley, spend $10,000 a month to live in a Cracker Jack box, and they can stay right where they are. So one of the investment thesis that we have is it's not that we won't invest in Silicon Valley companies. In fact, we're in the process of opening an office there right now. I think it's super important to be connected to the motherland, and it truly is the motherland. But on the other side, the majority of the hunting and the sourcing that we do, it's Miami, and it's all over the world. So we have an office in Dubai that covers the entire GCC region. We have an office in Mexico City, a fairly good-sized office in Mexico City that covers a lot there. We have a small office in Guatemala City that covers Central America. We're in London. We just closed our office in the Nordics. But because of that, we have boots on the ground, and we have companies in Sweden, we have companies in London, we have companies in Israel, we have companies in Dubai, we have companies in Abu Dhabi, Saudi Arabia. So when an investor who is allocating to the creative economy, when they look at us, we are truly giving them a diversified portfolio of creative economy companies that you're probably not going to see if you're only going to invest in the West Coast of the United States. So a part of that is Miami, right? And there are some incredible, companies that are being built in this city that don't get near the recognition that they should. We just got done talking about Betr, but just to brag on them a bit, it's the fastest growing online sports gaming company in the United States and the 3rd most popular sports media platform in the United States. And we own a category of consumers between 18 and 30, age 18 and 30, that you have to almost add up everybody that we compete with just to get to those numbers. And that's right here in Miami. And there's a lot of other things, a lot of interesting AI that's coming online here in Miami. We just invested in a legal AI platform, which I think is going to be incredible. So there's a lot of really interesting things that are going on here. And again, if you're you and I talked about this earlier, Paul. If you're going to the portfolio construction of the old days used to be, you put 75% of your portfolio in, different international equity, long, short equity, and then you had fixed income 25%. That's kind of what it looked like for a really long time. Today, if you run into a financial advisor, anybody in the wealth business that is talking to you about creating a portfolio that looks like that, run like hell the other way, because it just doesn't make any sense. That's not a part of modern financial modeling. And today, you need to have 20% of your portfolio construction in alternative investments. Where venture capital fits in that, I obviously have a strong opinion of where that needs to be. But you're inside of that 20%, half of it, maybe a little bit more. And so if you're going to do that, you probably want to put some money in Silicon Valley, but you want to put it in a firm like ours. Northeastern, 10X dominates the Northeast, and I like to think that we dominate the everything south of the Northeast. So.
When you both think about capital deployment from an investment perspective, is there a check size or an entry point that you look for? Is there a percentage investment that you look to make in a portco that matters to you, or that there's a threshold in your minds? Or how do you guys think about that from an investment process perspective?
If I jump in on that, again, remember where I came from. I was in capital markets for 21 years. I'm a former investment banker. I did a lot of different things. So I look at the creative economy through probably a little different lens than someone who's just traditional venture capital. So a big part of my team, like my chief investment officer, is a former long-short hedge fund manager. That was purposeful for me. I wanted someone to come in and think heavily about risk. I think oversized returns can be accomplished if you're doing your job the right way. But how are you managing risk? One of the problems that you hear a lot of individuals who really don't know the space very well, they'll say, well, the average manager is going to lose 80% of the portfolio of companies that they invest in. I think that's a horrible number. So our philosophy around that is what we call phased investing. So we want to own 10 to 12% on average normally of the company. Sometimes we'll do more. If we put our private equity hats on, sometimes we'll own the majority of a company. We did that with a company that was a part of Spotify, and we spun it out of Spotify, and we put it onto its own brand, which used to be Spotify for Business. Now it's Soundtrack. We just exited that company. But that was a deal that we went in and we wanted control, and then we kind of curated it and exited it the way that we wanted to do that. But typically it's 10 to 12%. And what we'll tell the founder is, look, we want to eventually own 10 to 12%, but we're not going to start there. And the reason for that is I want to get to know that team. I want to understand where their gaps are. I want to see where the skeletons are in the closet. I really want to understand the tech stack. So I might start with $1 million check. And then as I get to know that company, we're on the board, there's nothing about us that's passive. We're very, very much involved in everything that's going on with the company. And then that check size will continue to get larger and larger. To the point, some of our companies, we have, as much as $55 million invested in that company, but it started with $1 million check. And so that's how we manage risk. And what that does for us in time, right? If you think about the public market and you think about the private market, what's the biggest differential between the two? In the public markets, information and knowledge is abundant. That's why it's public. We can identify a company and we can stack this room from floor to ceiling with information and make very, very solid analytical investment decisions. Feel very, very good about the investments that we make. In the private sector, however, knowledge and information is scarce. It takes a team. It takes network to understand it, but more importantly than anything else, it comes in time. That's how you learn, that's what you understand what's going on. And so what we're trying to do is factor in time into our investment thesis to buy down risk, and we do that by phasing our investments. What ends up happening at the end, which is quite interesting if you're interested in portfolio construction, but at the end, what ends up happening is there are companies that may not hit the KPIs. So our deal is you meet or exceed the KPIs, you will always have fuel. But if you have a company that's not meeting those KPIs, we'll invest time, energy, and mental capacity. We won't invest the capital. We'll try and get you back on track. But sometimes it doesn't happen. So the reserves that you've set aside for that company, now where are they going to go? Where are they going to go? This is the interactive part. Where are they going to go? No, they're going to go to the companies that are performing. So if you had set aside, let's say you wanted to own 10% of this particular company and you set aside $9 million in reserves, That's how you get up to those 25, 35, 45, $55 million in total, because what you're doing is you're starving the companies that are not performing, and you're watering the hell out of the companies that are doing well, and that's how we do it.
And David, if you were to take off your 10x Capital hat and put on your Weisburd Capital hat, is that mentality the same, different? How do you view?
Yeah, so to answer that, I think the best way to look at the venture capital market, or any market in general, is what will hyper-rational, hyper-efficient markets do? So if you are a fund and you are competing against the Sequoia Capitals, the Andreessen Horowitz, the Founders Fund, Peter Thiel's fund, what is your right to win? How do you beat them head-to-head? There's a couple of strategies that work and that have worked historically. Getting lucky, finding somebody that's not a good startup and ends up being successful, that's not a strategy that's repeatable or really historically has performed over multiple funds. There's a couple strategies. One strategy is your check size. So if you look at a seed round, it might have a $2 million capacity. You have the lead investor. Think of the lead investor like the major leagues. That's where the top funds will compete against each other. It's very difficult to go head-to-head against the top funds. Then you have the second tier, the 500K checks, and then you have the small checks. Me, as an investor, I could get into any company in the world at the seed with a 25K check. It's not because I'm that special. I have a brand. I have access to media. Anybody would take me for 25K. If I want to put $1 million, that's going to be hyper-competitive. So one of the ways that venture funds are able to return really well is by keeping their funds small and by keeping their check size small. The second one is either going one round below the top funds or hyper-focusing. I may not have a better brand than Sequoia Capital, but I might be the best SaaS investor in the world. Somebody like a Jason Lemkin, he has a following of probably 500,000 Twitter followers. He's written about SaaS before it was cool. He's going to write about SaaS now that's not cool. If you're a SaaS company, you probably want to go with him than an associate or a junior partner from Sequoia. So those are the two ways to think about check size.
No, thank you both for that. Super insightful. And then if we take a step back to something that was discussed earlier today in one of the first panels, I think history is a big indicator of what we might see in the future. And something that was brought up earlier today by Amity Schleus was the historical significance of productivity and its impact on the economy and the quality of life of individuals. So if we put on our investor hats and we think about productivity, and we say, okay, U.S. saw productivity gains in the 1920s that, in Amity's words, gave us Saturdays. Are the 2020s via the productivity gains that we may get through AI going to give us our Fridays? How do we think about productivity gains through technology, like, for example, AI?
I think 5-day-a-week work week is probably a thing in the past, starting in a couple of years. I think one thing that people repeatedly underestimate is the compounding of exponential gains. So people look at AI as something that's going to happen in 10 years, but something more likely going to have serious effects in the next couple of years. I think the DeepSeek, the new AI model that was not really trained for $5-6 million as reported, but is still kind of a leap forward on AI, is going to be a very good thing for startups, maybe not as good for their competitors like OpenAI. So I think we're going to see those gains. There's a lot of other things that need to happen in the meantime. The models aren't quite as good enough. I just interviewed the CEO of Invisible Technologies, which basically works with large language models like OpenAI's to improve them. They have PhDs that improve the models and fine-tune them. So I think there's a lot of middleware, and there's going to be a lot more companies that are focused on very specific verticals, because a medical AI might be very different than a language AI, or just if you're trying to learn a language. So I think we're going to see a lot of verticalization. I think we're going to see astronomical productivity gains. What we don't yet know is whether those productivity gains will lead to this Cambrian explosion of new types of companies, which has historically been the case with technologies. Like, a lot of people thought that a lot of previous kind of orders of new technological revolutions would actually take away jobs, but they increase jobs. So that's likely will happen again.
Jeff, do you have any comments?
I think everything that he said is spot on. So, to kind of put it in my perspective, I think that in 5, this is my humble opinion, but I think my team is extremely focused on doing due diligence on AI companies right now. We've been doing it for over 4 years, and my humble opinion, but I think in 5 years we're going to look around and we won't recognize most of anything. So you talk about productivity. I think it's changing. I mentioned that legal AI that we just invested in. We piloted that technology for 6 months. It saved us $350,000 in legal fees just in 6 months. And I'm at a point right now where I really do, I sit back and I think to myself, I don't really need a corporate attorney anymore. Now, if I ever needed a litigator, that's a different story, right? If I need someone to fight a battle, I think that the legal world will always need that. But for someone like myself that just needs to, take a term sheet, hey, how does this affect the last term sheet? And it's crazy. I want to really look smart. How would I redline this thing and give it back? And it'll literally just give it to you. It's crazy. So that's productivity. We're looking at a company in the Nordics with one of the largest shipping companies. I won't mention it, but you can figure it out. One of the largest shipping companies in the world. And there's a guy who's been in the AI space and in global trade for quite some time. We invested in another one of his companies that we exited to HSBC about a year ago. And I was visiting with this shipping company that's using the software. And he says, look, Jeff, here's the deal. And this is the CFO of the company. It's a really large global company. He said, I'm not going to sit here and tell you I have any idea what the hell this thing is doing, but I'm going to tell you this. 6 months ago, I had 150 people that were working in my division, and if we were going to detail the month of January, for example, and create the books and records and everything that we need to do for one single month, it would take us 3 months to do that. He said, I now have 50 people in my division, and we can get through it literally in a day. And he says, the 50 people are simply there because I cannot figure out how this is working, and I'm just afraid it's wrong. And so once I get over that, I'm probably only going to need 10 or 15 people. So that's productivity, right? That's game changing, and I think it's going to change a lot of different things. But I really do believe in 5 years we're going to look around and it's going to be just mind blowing at how things have changed. Now, when you say does it go to a 3-day work week or a 4-day work week or 5-day work week, that's the piece that I struggle with. I think that we need to, a lot of people ask me, well, what should my kids be studying in college? I don't think it should be, there's nothing wrong with having a law degree because it really, I think, gives you a great edge on things. But I don't necessarily think you're going to become a corporate, attorney with that background. I think it can give you an edge. But the world is going to definitely change. But I don't think the people who are fighting for that 1%, I don't think it's ever going to change. Like you talk about 5 days a week. I work 7 days a week. I've been doing this for a really long time. Someone asked me the other day, I don't even remember the last time I took a week off. I mean, maybe it was like 4 or 5 years ago. I don't know. But how the hell are you going to be competitive in a world like that if you're working 3 days a week? You could do it if you want to. There's nothing wrong with that. But if you're trying to build something special or you want to live an extraordinary life, you have to work an extraordinary week, I think. So I don't really know how to answer that question. I think for the right people, it only gives us more opportunity to get even more than our fair share. And I love that. So that's how I look at that.
And I think I've been asked the same question, like what should students learn in university? And I think there's two kind of paradoxical answers to that. One is sales or influence, being able to sell, relationship management. That's going to be one of the last things that's going to be commoditized by AI. And the second one, paradoxically, is engineering, because engineers are able to apply the next level of AI, and they just get more and more leverage. So if you think of a software engineer might have had 5x leverage 20 years ago today might have 100x, in the future might have 10,000x leverage. So being a really good engineer and being a really good salesperson or influencer in terms of relationship manager, and then you could argue also branding and media.
And then, I mean, we could obviously talk about AI for hours, but beyond AI, are there any other technologies that you're really honing in on from an investment perspective that you think have a place in your portfolios over the next, 2, 5, 10, 20 years, beyond just AI?
I think nuclear energy is very interesting, and defense technology seems to be having a renaissance today, and there's different applications of that. I was just pitched yesterday a humanoid robot that's focusing on defense, not shooting people, but carrying. There's a lot of logistical issues with the military having to carry things. So defense and nuclear is what I would say.
Obviously, those are good. The defense side, I just had a really bad experience with a very large investment that we had that was basically taken over by Lockheed Martin, and it didn't turn out. I mean, when you're dealing with defense, my humble opinion, you got to really be careful, because these are big boys and they can kind of do whatever the hell they want to do. And they showed me the door. Let's just say that. So I'm a little leery on that particular area. I think there's a lot of opportunity there if you can do it right and you have the right connections.
I will say also the new Secretary of Defense is very innovative in thinking.
Yeah.
The issue with defense in the U.S. and other countries historically has been, it's always fighting the last war. After World War I, everybody was just charging at each other. They thought that's how wars needed to be fought, and then Germans innovated on that. Same thing today. You have drones instead of just having these huge bombers. So I think the new secretary is a very, very positive sign for the defense industry.
I agree with that.
On that note, and Jeff, I would love to hear your opinion. Do you think the current administration is more growth asset, early stage friendly, or how would you view the next 4 years from an investment landscape perspective?
Yeah, so you always got to be careful with this one, right? So not looking at political opinions or policies. Well, I shouldn't say policies, but just political opinions. I think our president that we have right now is extremely pro-business. I think that he has done an incredible job of surrounding himself with some of the most brilliant minds on the face of the planet, and those people tend to have a very connection with technology. So I think technology over the next 5 years, or let's just call it the next 4 years, is going to be very positive. I think that the next 4 years, again, my humble opinion, and again, we're venture capitalists. I'm very optimist person. If I'm not, I shouldn't be in this industry. But I think the next 4 years is going to be unbelievable. I think that everybody in this room and anyone that we know, you have to work harder than you've ever probably worked. And if you do that over the next 4 years, you're going to live a life that you never even dreamed that you could live. And I think, at least for me, at the end of that 4 year or 5 year period of time, my life cycle, I'll probably never see that opportunity again. I think we have an incredible opportunity. I think the current administration is very pro-growth, very pro-business, very pro-technology, and I think it's, the president said it, it's the golden age, and I actually very much believe that. And my team is very focused on trying to take advantage of that.
Yeah, I think there's a couple of themes that are really interesting given new administration. One is, as I mentioned, defense tech and nuclear. The other one is there's a lot of focus, a lot of the Trump agenda is around making America basically redundant from a supply side, so building in America. So a lot of industries will now be rebuilt in America, a lot of supply chains. And of course, crypto was, I don't know what would have happened if Harris had won the presidency from a crypto perspective. It would have been potentially disastrous. And now there's regulatory clarity. Before the SEC was functioning under this guise of basically, we'll tell you if you're doing something wrong, no clarity on rules. Today you're gonna have clarity on rules and also a pro-crypto SEC. So I think that's a huge tailwind. I think the US has a real chance to really win the crypto kind of global war from that perspective, and AI as well.
Excellent. And then before we jump into Q&A, I'd love, and maybe Jeff, since you've been boots on the ground since 2017, you could answer first. What initiatives or contribution from individuals or organizations will help kind of fuel, no pun intended, the...
Appreciate that, by the way.
Yeah, my little plug. Will kind of help continue the path that Miami is on from just a broader tech ecosystem perspective?
Yeah, I talk a lot about this, and it's a frustration for me. I think we have so much opportunity, but at the same time, I think that there's things that are missing. So, whenever I'm asked to come and spend time, on a panel like this and alongside other great investors, I want to do it. I think what's missing, again, my humble opinion, I know I've said that a number of times, but my humble opinion is that what's missing is the community hasn't really locked arms yet. And I'm pointing inward. I think there are a lot of things that I need to be doing better in order to move things forward. I think we are the very first, venture capital firm in Miami, and it's a legitimate firm. And so we have a responsibility, and we're trying really hard to make those efforts. But I think if you look at the other ecosystems where it has really done well, obviously Silicon Valley is, as I said earlier, the motherland. What happened there? If you really analyze it, what took place is you've got a great educational foundation. You've got, and as a result of that, you have a lot of creatives that are coming together and leveraging their skill sets and saying, here's a vertical that hasn't been disrupted. I was talking about global trade earlier. It's bananas, but today's global trade, 68% of today's global trade is still done on a piece of paper and a fax machine. There are people in this room that don't even know what a fax machine is, but that is the global trade. So you have brilliant creators who are saying that makes no sense, and I'm going to apply technology, I'm going to apply, and disrupt that. And I think that that's a very investable, vertical for us. So that's one of the things that you asked that question earlier. So then what ends up happening is the community gets involved. The community starts to write angel checks, right? If you go to Silicon Valley, there are more angel investors there than you can shake a stick at. And it's people writing $1,000 check, $5,000 check, $10,000 check. And they might put that into 25 companies, right? And then all of a sudden they hit gold, and then they put it back in, and it just keeps evolving. What hasn't happened in Miami yet, when I look at my firm and I look at the assets that we are responsible for, first of all, 55% of our LPs are not from the United States. That which is in the United States is majority outside of Miami. I mean, I think that what represents our AUM, our assets under management, is like 1% comes from Miami. That's broken. That's just as broken as it gets. So how do we fix that? How do we get the community to be supporting these incredible founders that are here and feel safe about doing it? And I think we've got to get to that point if we're ever going to reach our full potential. If we don't do that, I call them, kind of pigeon citizens, right? It's just people who are flying in, and they're taking our reservations, and they're making it really hard to get from point A to point B, and then they fly away. They're not dropping anything off. They're not making a contribution. They're not supporting the ecosystem. And we've got to fix that and change that. And that's by, people like you and what you're doing, Paul and JP Morgan. That's how it starts. We're in the first inning of this thing, guys. I mean, Miami Tech is really 5 years old? I mean, that's just at the beginning. But these are the things that we have to do. We have to continue to lock arms with great institutions who get it, right? JP Morgan is a firm, I come from that world, I can say this, but that's a firm that actually, gets it, is constantly iterating, constantly, trying to provide support. Look, you're sitting here right now doing this. There's a lot of other firms that wouldn't be doing that. So that's a big deal. And then, leveraging individuals like us, right? If you're in the community and you always had, interest in being a part of the creative economy, you want to make investments there, you have access now. You didn't have access before, but now you do, and you can lean into folks like us, and you get a diversified portfolio, and you're not going to get hurt. And I think that that's important.
I think it's a very predictable way to build a startup ecosystem. It's the reason why Silicon Valley continues to be Silicon Valley, despite shooting itself in many ways. It's quality engineering, and the long-term investments into engineering talent in Miami, University of Miami, FIU, Miami-Dade, is absolutely critical for the flourishing of the ecosystem. Think of it this way: how much more difficult is it to convince somebody to stay in Miami versus uproot and move to Miami? So you want to create this insider advantage by investing into the engineering and having quality engineering. And once you have a critical mass of that, I think for many people it'd be obvious to stay in Miami if they had enough engineering talent.
Amazing. We'll open to Q&A now. So if anyone does have any questions, no Q&A? Take it to the bar. Okay. David and Jeff will both be here. They will be at the bar, so probably will answer your questions even better at the bar. So I encourage everyone to approach them, say hello, and then ask any questions that you may have. Thank you guys so much.
Thank you.